live out of Melbourne. Chris, great to have your company on the program today. Your view on markets at the moment, given what we're seeing overnight from Wall Street, weak leads, of course, for equities, as we see a tightening cycle take place. Here at home, there's obviously a lot going on in the macro as well, but what do you make of the flat session today?
Good afternoon, Ingrid. I think we're probably about where we need to be. As Adam and you have mentioned, obviously we got the interest rate hike in the US overnight. There was a shift in the dot plots. I don't think that was particularly unexpected, again reiterating what Adam said, and that's because last time out from memory, and please correct me if I'm wrong, that there was one vote or one person on the Fed board that was needed to tip that from 3 to 4. So it was almost a done deal last time. It's a done deal this time, but we must all remember that these are Fed members. It's their best guess of where they think rates will be over the coming 12 months, and that obviously can change. So yeah, I don't think it was particularly unexpected. A little bit of weakness, and we've fought back from some early weakness today. So like I said, I think we're about where we need to be, or very slightly ahead of where we hope to be.
What are you expecting for the Aussie market? And I'll ask you this a lot, Chris, but in terms of technicals at the moment, 6,025 is where we're sitting. You say that if we drop below 6,000, there could be some sort of risky levels there. What are you watching for downside risk when it comes to the Aussie share market?
Certainly, I think if 6,000 fails, and when I say fail, I mean fail significantly, not sort of down to 59.70 or 59.50, because we have seen those moves below 6,000 a couple of weeks ago, and ultimately they were defended. But if we get a clean breakdown, then I think 57.50 is the next sort of logical technical level. But ultimately, I think 6,000 will hold. You know, I think we're likely, because of the psychological significance, if nothing else, of the 6,000 level, that we'll test it a couple of times and repeatedly. But ultimately, unless there's a seismic shift in the fundamental narrative, I don't think that level gives way.
All right, I want to get your view on something, Chris. Inghams. I know you like this stock at the moment. There was a change of CEO announced last week. We saw a big hit in the share price, very large hit in the share price off the back of that news. The stock's up about 0.4% today, sitting at $3.76. Before the new CEO, it was sort of near a record high. So what's your take on this one? Why do you like the stock?
Exactly as you say, Ingrid, there was a change of CEO. The incumbent CEO announced that he would not seek a new contract. They haven't actually found a new CEO yet, I don't believe. But the stock sold off, more importantly, the stock sold off 10% on the day. Now, obviously, that lends to the fact that the investor base liked the CEO and thought he had done a good job. But we just think that 10% sell-off is too great. And that's because this company, we believe, has a long-term sustainable competitive advantage. That's reflected in the fact that we're all consuming more chicken and turkey and poultry around Australia. And these guys, have the ability to improve their costs. So they have been improving their output at their last set of results, but their costs had been going up in terms of electricity, gas and feed. So if we think they can rein in those costs a little bit, obviously that's going to expand their margins. And the 10% sell-off just makes it more attractive from a valuation perspective. So I think it's on a less than 13 times forward and a yield above 5%. So some nice metrics there that make us want to take advantage of that 10% sell-off post the CEO resigning.
Adam, do you have a view?
Look, I certainly, we always get a little bit concerned, and probably Chris can probably agree that, when a CEO does leave, there is that sort of uneasiness in the share price, and that sort of does sort of lead to why they're leaving, and does complicate things a little bit more. I do worry about those higher costs, and if they can offset that or do that okay. There was a couple of sort of broker downgrades on it the other day, but it seemed to have like it's sort of bounced back a little bit now. So yeah, I'm really comfortable with the story. I don't have many clients in it, but I do feel that, we're health conscious, more chicken's being eaten, all of those kinds of things. I think it's a good story.
Yeah, Chris, how does the supermarket wars play into this? Because we know how much power Coles and Woolies have had in the past. I mean, do you see some decreasing power there when it comes to Inghams in terms of, I guess, a benefit to Inghams going forward?
Yeah, absolutely. That's one of the factors of why we like it. And exactly as you say, with the arrival of Aldi and now Kaufland's coming as well, another big German operator, it decreases the monopoly power or oligopoly power of Wesfarmers and Wesfarmers and Coles and Woolworths. I'll get that right, of course. And that feeds into Inghams being able to demand a higher price and a higher premium for their products, because obviously there's more demand across multiple buyers.
All right. Also, just finally, a lot of deals going on in the US at the moment. Obviously, that huge AT&T deal. M&A not only therefore in Australia, but we're also seeing a bunch of it over there, quite a bit bigger. Obviously, we've been looking at Comcast now having a tilt at 21st Century Fox. What do you make of these huge deals going on in the US at the moment?
So I think the read-through for us locally, obviously last night it was driven by a court decision, and that was the US courts allowing the AT&T and Time Warner tie-up, and that has allowed Comcast to have a tilt at 21st Century Fox's assets. Disney had previously bid $52 billion, now Comcast comes out with 65. But I think the read-through here, because we don't have such big, in particular, media players, is what's really happening more broadly, and there's a lot of disruption going on. And when I think about what that could mean for sectors here, I'm thinking about the likes of Telstra, where you've got these old incumbent businesses that have had a competitive advantage for a long period of time. They're being disrupted. New technologies are disrupting, so it's happening in the retail space as well. Of course, you know, the oldies like Myer and Harvey Norman, all of a sudden Kogan comes along and takes a bit of market share. So media, retail, supermarkets as well, as we were just talking about, again, you know, being disrupted. So I'm just taking that idea and that theme and seeing where it applies locally, and I think it's important. I think it's something that investors need to be aware of, that, you know, just buying and holding a Telstra when it's being disrupted is not probably the right thing to be doing.
Adam, do you agree with that?
Yeah, I do. Yeah, it's certainly with a lot of stocks these days, that disruption is moving throughout any industry. You know,
how do you play that though? I mean, do you play that on the hope for consolidation and takeover bids for certain stocks? I mean, or do you not really buy a stock on a potential takeover premium?
I think it's risky buying stocks on a takeover, because generally those stocks that are getting taken over have been underperforming. APA, as a classic example, has been underperforming for a while now. So, you know, it's a risky business to try and preempt what was going on. But we did speak with our property analyst last week and said to him, okay, if something was going to get taken over in that space, and it's nice because it's all happened now, but he did say Gateway last week. We went in and bought a couple of shares for some clients, and that has been a fantastic result.
Yeah,
so it's really great to have that analyst or somebody there to be able to lean on to say, look, if something was going to happen, what would it be? So, you know, you have to back some of those calls sometimes.
Yeah, Chris, and I know you're a trader, but do you, so in a way, I guess you could make a lot of money off sort of bidding on takeover premiums that may come into light. Do you do this much? I mean, if you're seeing consolidation in a space, do you sort of try to pick the winners?
No, not really, Ingrid. Usually because, you know, it's difficult to assign whether it's anything more than a 50-50 proposition.
Yeah.
Probably the latter of the question that you posed to Adam. It's more about avoiding stocks that are going to find it very, very difficult to perform given disruption in their sector and competitive forces.
All right, Chris, really appreciate your time on the program. Love having you on. Thank you for joining us.
Thanks, guys. Cheers.
Chris Conway from Australian Stock Report.